Hello everyone. Chapter 9, Making Capital Investment Decision. In Chapter 8, we learned the measures of capital budgeting decision with given cash flows. In this chapter, we will learn how to estimate and forecast these cash flows. The first thing we need to do in estimating future cash flows from a project, we need to figure out which cash flows should be included and which ones should be excluded. The cash flows that should be included in a capital budgeting analysis are those that will only occur if the project is accepted. These cash flows are called incremental cash flow. The incremental cash flows are simply calculated by corporate cash flow with the project minus corporate cash flow without the project. In detail, you should always ask yourself, will this cash flow occur only if we accept the project? If the answer is yes, it should be included in the analysis. Because it is incremental, if the answer is no, it should be excluded in the analysis because it will occur anyway. If the answer is the part of it, then we should include the part that occurs because of the project. These are the examples that we need to determine. First, sunk cost. Sunk costs are the ones that you already spent. To determine whether the cash flows are relevant or not, you should find the answer, the question. In the previous slide, will this cash flow occur only if we accept the project? The answer is clearly no, since we already spent it and it occurred anyway. So sunk costs are not relevant, exclude. Opportunity cost. The definition of the opportunity cost is the most valuable alternative that is given up if the particular investment is undertaken. For example, suppose you have an old machine that you may convert to use for your project. If the machine can be used elsewhere, the cost of the machine is not free. We give up some valuable opportunity because we use this machine only for our project. Or at least you may sell it. This type of cost is called opportunity cost. Now, is it relevant? Answer the question. The answer should be yes, because we give up some opportunities only if we undertake our project. Side effect. The project we evaluate may affect the cash flows of other projects. For example, if Apple launched new iPhone, sales of older model should decline. This is called erosion. In case of erosion, it is important to determine that sales loss happens not because of future competition increase, regardless of launching a new product, but because of a new project itself. Net working capital is another factor. For example, a firm needs some cash in doing a project. It may need some initial inventories and account receivables. Any net working capital changes because of the project should be included in the analysis. Usually, the firm supplies working capital at the beginning and recovers it toward the end, since most working capital needs will be recovered back by selling inventories, collecting cash, etc. Financing costs are not generally included since we are interested in cash flow generated by the asset of the project. For example, interest paid is a component of cash flow to creditors, not cash flow from asset. Financing decisions should be separately analyzed besides capital budgeting decision. Lastly, tax. It is critical. Any taxes from the project is obviously relevant cash flows. Capital budgeting heavily relies on pro forma accounting statement, particularly income statement. The way to estimate cash flow is quite similar to finding cash flow from assets from Chapter 2. We know that there are three components: operating cash flow, net capital spending, and change in net working capital. We also already learned that operating cash flow equals to EBIT, earnings before interest and taxes, EBIT, plus depreciation, which is non-cash item, minus taxes. Because EBIT minus taxes equals to net income, if there's no interest expense, it will be net income plus depreciation without interest expense. As we saw in the previous slide, we usually exclude financing costs, including interest paid. So in most cases, net income plus depreciation is enough to get operating cash flow. Let's see one example. Suppose a project is forecasted to sell 50,000 cans of shark attractant per year with $4 per can. Variable cost per can is $2.50 and fixed cost is $12,000 per year. The lifetime of the project is 3 years and initial equipment cost is $90,000. It will be evenly depreciated over a 3-year life. So each year, depreciation expense is $30,000. Annual net working capital investment is $20,000. Tax rate is 21% and required rate of return is 20%. Let's analyze this project. Let's build pro forma income statement. Sales per year is $50,000 unit times $4, $200,000. The variable cost is, again, $50,000 unit times $250, $125,000. So EBIT is sales minus variable cost minus fixed cost $12,000 and depreciation, annual depreciation $30,000, which is $33,000. Since the tax rate is 21%, the amount of taxes is 21% of the $33,000, $6,930. Then income is $26,070. Then operating cash flow equals to net income plus depreciation. So $26,070 plus $30,000 depreciation. Annually, operating cash flow is $56,070. How about changing net working capital? Each year, $20,000 net working capital is needed. So if you find changes, initial changes, 20,000 increases, and then no changes from year 1 to 2 and 3. In final year, however, all net working capital should be recovered since it will be eventually recovered. So in final year, this $20,000 will be changing, will be recovered. So negative 20,000 will be the change in net working capital. Note that these changes is negative factor of cash flow. So 20,000 increase in change in net working capital is total cash flow decreased by 20,000. If the net working capital decreased by 20,000, then total cash flow increased by $20,000. Let's look at the projected total cash flows. First, net capital spending is simple. Initially, a firm needs to pay $90,000 to buy equipment. And then in final year, it may sell equipment, but since salvage value here which is value at the end of the project is $0. There will be no capital spending in final years, nothing. Combining all, operating cash flow from year 1 to 3 is $56,070. Change in net working capital in year 0 is negative $20,000 because again, increase by $20,000 net working capital, decrease total cash flow by the same amount. Final year, $20,000 positive. Net capital spending only $90,000 negative in initial year. And total is year 0, initially negative 110,000. Year 1 and 2, $56,070, and year 3, $76,070. Now it is time to make a decision. To do so, we need to compute NPV and IRRs. Using cash flow worksheet, cash flow 0 is negative $110,000. Z01 is $56,070, and if you just keep F01 equals to 1, just ignoring the same cash flow in the future, and separately put each cash flow into the cash flow worksheet. C02 is again $56,070, and F02 equals to 1. And then C03 is $76,070, F03 equals to 1. Or since we have same cash flow year 1 and 2, we can combine. You can put CF0 negative 110,000 and C01 56,070, and then you can make F01 equals to 2, which handle year end 1 and 2 cash flow together. C02 is the next cash flow next to the second cash flow, so which is cash flow 3 actually. 76,070, and you have F02 equals to 1. Again, note that here C02 is year 3 cash flow because C01 handles year 1 and year 2 cash flows together. Now press NPV. We know that required return is 20%, so 20I, and down press CPT. Then you have $19,684.49, which is positive, accept the project. Compute IRR, so press IRR and compute. IRR is 30.57%, greater than 20% I. Again, accept the project. This is how to make capital budgeting decision. Forecast cash flows and compute NPV and decide. You can also use Excel. Double click this Excel icon. You will see this Excel spreadsheet. And there will be the formula in each cell, especially red cell. And you can see how to get it. Exactly same answer and accept. So just for your reference, I embed Excel template here. Pop quiz 1. A firm is looking at a new equipment with an installed cost of $438,000. The equipment will save the firm $129,000 per year in pre-tax operating cost. Each year, it will be depreciated by 20% of the cost of equipment. The tax rate is 21%. Find the annual operating cash flow. One thing you have to carefully hit. There's no changes in revenue, but there's cost savings, which increase your earnings. Okay, so find it. To find operating cash flow, we need to build pro forma income statement. Starting with sales, now revenue, sales does not change, so 0. But instead of changing sales, cost decreases by $129,000. Annual depreciation is 20% of equipment $438,000 of 20%, $87,600. So EBIT is sales minus cost minus depreciation. That's EBIT, EBIT. $41,400. So negative of negative is positive, right? Taxes is 21% off is EBIT, which is 8,694. So net income is $32,706. That's net income. So operating cash flow is simply net income plus depreciation. 32,706 plus 87,600, which is depreciation amount, then $120,306 each year. This is the end of the part one. We'll see more detail about project cash flows next part. See you there.